I'm watching something happen in the silver market that I've seen play out with mathematical precision for over 7 decades, and it tells me more about systematic market manipulation than any congressional hearing or regulatory investigation ever could. The CME Group just raised silver margin requirements by 35% overnight, triggering a cascade of forced liquidation that destroyed billions in silver positions within hours, and this represents the latest chapter in a systematic manipulation playbook that's been used to suppress precious metals prices whenever they threaten to break free from institutional control. What concerns me most about this latest margin hike isn't the immediate price destruction we're witnessing in silver futures markets. It's the systematic pattern of regulatory intervention that occurs whenever precious metals markets begin reflecting the true monetary debasement and currency instability that central bank policies have created over the past 15 years of unprecedented monetary accommodation. The timing of these margin increases is never coincidental. They always occur at precisely the technical moments when silver is breaking through resistance levels that threaten institutional short positions. Let me explain exactly what happened here and why it represents systematic market manipulation that makes the silver market fundamentally different from other commodity markets in ways that patient capital must understand before allocating resources toward precious metals exposure. When the CME raises margin requirements, they're not responding to increased volatility or genuine risk management concerns. They're creating forced liquidation events that benefit the massive short positions held by the same bullion banks that dominate silver derivatives markets. The mathematics are straightforward but devastating for leveraged speculators. When margin requirements increase by 35% overnight, traders who were using maximum leverage suddenly need to deposit additional capital equal to 35% of their position size within 24 hours. Most speculators don't have that additional capital sitting in cash, which means they're forced to liquidate positions at whatever price the market will bear. That forced selling creates the very price decline that the margin increase was supposedly designed to prevent. I learned about silver market manipulation firsthand back in 1997 when I accumulated 129 million ounces of physical silver, about 17% of annual world production at the time. The position made perfect sense from a supply-demand perspective because industrial consumption was exceeding mine production while inventory levels had declined to critically low levels. But what I discovered was that the silver market isn't governed by normal supply-demand economics. It's controlled by a small group of bullion banks that use derivatives markets to suppress prices, regardless of underlying fundamentals. The regulatory capture that enables this systematic manipulation extends far beyond the silver market toward fundamental questions about whether commodity markets can function as genuine price discovery mechanisms when regulatory agencies coordinate with financial institutions to prevent price movements that threaten existing power structures. The CME Group isn't an independent exchange responding to market conditions. It's a profit-seeking entity that generates massive revenue from the very volatility that these margin hikes create. Here's what most investors don't understand about precious metals market structure. The paper silver market, futures contracts, ETFs, and derivatives trades volumes that are 50 to 100 times larger than actual physical silver production and consumption. This massive paper market allows a relatively small number of financial institutions to control silver prices through derivatives trading that has virtually no connection to physical silver supply and demand fundamentals. The concentrated short positions held by just 4 bullion banks represent systematic manipulation that would be prosecuted as criminal conspiracy in any fairly regulated market. But precious metals markets operate under different rules because they threaten the monetary system that benefits the same financial institutions that control derivatives trading. When silver prices rise rapidly, they signal currency debasement and central bank policy failure that undermines confidence in fiat monetary systems. The Hunt brothers' silver manipulation in 1979-1980 provides the historical template that current regulators use to justify systematic intervention whenever silver prices begin reflecting monetary reality. The narrative that speculative excess caused the Hunt brothers' attempt to corner the silver market obscures the fact that they were responding to genuine monetary debasement during the Carter administration's inflation crisis. Their manipulation attempt failed not because of market forces, but because of coordinated regulatory intervention designed to protect the financial institutions that were short silver. Today's margin manipulation follows the identical playbook, with updated technology and more sophisticated coordination between exchanges, regulators, and bullion banks. The moment silver begins breaking through technical resistance levels that threaten massive short positions, margin requirements get raised to trigger forced liquidation that drives prices back down below those resistance levels. It's systematic intervention disguised as risk management. The silver supply-demand fundamentals remain as compelling today as they were in 1997. But the manipulation mechanisms have become more sophisticated and systematic. Industrial demand for silver continues growing due to solar panel production, electronics manufacturing, and medical applications that require silver's unique conductivity and antimicrobial properties. Meanwhile, mine production has been declining due to depleted ore grades and environmental restrictions that make new mine development increasingly expensive and time-consuming. Physical silver inventory levels have reached critically low levels at major exchanges, but paper silver trading continues at volumes that suggest unlimited supply availability. The London Bullion Market Association and COMEX warehouses report inventory levels that could be depleted within weeks if even a small percentage of paper silver contracts demanded physical delivery. But the margin manipulation system ensures that physical delivery never reaches levels that would expose the systematic overselling of silver that doesn't exist. The ETF silver market represents another layer of manipulation because most silver ETFs don't hold the physical silver that their marketing materials suggest. They hold derivatives, custodial agreements, and paper promises that would collapse if significant numbers of investors demanded actual silver delivery. The systematic failure to audit ETF silver holdings enables massive paper selling that suppresses prices while creating the illusion of adequate silver supply to meet investment demand. International silver markets face identical manipulation through coordinated central bank intervention that prevents precious metals from reflecting the currency debasement that quantitative easing policies have created across all major economies. When silver prices rise rapidly in dollar terms, they begin rising in euro, yen, and yuan terms as well, creating systematic pressure on all fiat currencies that central banks cannot tolerate without admitting the failure of their monetary policies. The geopolitical implications of systematic silver manipulation extend beyond immediate market manipulation toward questions about whether American financial institutions can maintain control over global commodity pricing when physical silver production is increasingly concentrated in countries that don't share American strategic interests. China, Peru, and Mexico control large percentages of global silver production, while simultaneously accumulating physical precious metals reserves that could be used to challenge dollar-based commodity pricing systems. China's systematic accumulation of physical silver through official and unofficial channels represents long-term strategic positioning that American manipulation mechanisms cannot control indefinitely. While American financial institutions control paper silver markets through derivatives trading, they cannot create physical silver through financial engineering. When geopolitical tensions eventually force a separation between paper and physical silver markets, the systematic manipulation that depends on derivatives control will collapse. The cryptocurrency market connections to precious metals manipulation reveal additional layers of systematic price suppression because digital assets provide alternative stores of value that compete with precious metals for investor attention during currency crises. When Bitcoin prices rise rapidly, some investor demand that would otherwise flow into precious metals gets diverted into cryptocurrency markets. This substitution effect gives manipulators additional time to suppress precious metals prices without triggering the massive investment demand that would overwhelm manipulation capacity. But cryptocurrency markets face their own systematic manipulation through exchange control, regulatory intervention, and energy cost manipulation that makes them unreliable alternatives to physical precious metals during genuine monetary crises. The advantage that physical silver maintains over digital assets is that it cannot be turned off, hacked, or seized through internet controls that governments can implement instantly during crisis conditions. The insurance implications of systematic silver manipulation affect portfolio diversification strategies because precious metals are supposed to provide protection against currency debasement and financial system instability. When margin manipulation prevents silver from performing its traditional monetary functions, investment portfolios become more vulnerable to systematic debasement that affects all paper assets simultaneously during monetary crises. The timeline for manipulation sustainability depends on physical supply constraints that financial engineering cannot overcome indefinitely. As industrial demand continues growing while mine production declines, the gap between paper silver trading and physical silver availability widens to levels that eventually become impossible to maintain through margin manipulation alone. When that breaking point arrives, the systematic price suppression will collapse rapidly as physical shortages force genuine price discovery. Patient capital interested in precious metals exposure must understand that silver markets operate under systematic manipulation that makes traditional technical and fundamental analysis inadequate for timing investment decisions. The manipulation can continue for years or decades, but it cannot overcome physical supply constraints indefinitely. The key is positioning for eventual manipulation failure rather than trying to time short-term price movements that are controlled by non-market forces. The compound effects of systematic manipulation extend beyond immediate precious metals markets toward broader questions about market integrity and price discovery mechanisms that support efficient capital allocation throughout the economy. When major commodity markets can be manipulated through coordinated regulatory intervention, all market pricing becomes suspect, and investment decision-making becomes based on political relationships rather than economic fundamentals. Physical silver ownership provides protection against systematic manipulation because physical possession cannot be liquidated through margin calls or exchange intervention. While paper silver prices can be suppressed through derivatives manipulation, physical silver retains its intrinsic value and monetary properties regardless of paper market pricing. The gap between paper and physical silver pricing will eventually converge, but physical ownership ensures participation in that convergence regardless of manipulation timeline. Markets eventually reward mathematical reality and punish systematic manipulation, but the timeline can extend far longer than most investors expect or can financially sustain. Silver market manipulation represents institutional protection of fiat monetary systems that will continue until physical supply constraints make manipulation impossible or geopolitical changes eliminate American control over global commodity pricing mechanisms. Patient capital must position accordingly while understanding that systematic intervention will continue until systemic changes make it impossible to maintain.